It all starts because the Fed raised way too high, way too fast, and the rest of the market didn't react well to it.
Right. So Grant, I'm gonna go back to you for a little bit because I've been looking through your Twitter here a little bit, and you did mention that you were ready for another potential recession, and you asked your followers, "Are you?" What would you say you did here? Are you not worried about the potential collapse in real estate prices, or those sort of effects from possible turmoil from the banks?
Well, yeah. Last March or February 2022, I let $1 billion worth of projects go. Walked away from non-refundables on 2 of the 4 because I thought this guy meant it when he said he was going to raise rates, and I saw how many people around me, the big guys, the Blackstone. I'm a little chump compared to these big players that were buying tens of thousands of units a year. The KKRs, PPIMs, Starwoods, Blackstones, the whole list of big shots that were buying tens of thousands of units and or constructing them using adjustable money. And I believe that if the rates went the way they have, from 0 to 5, I didn't imagine he would go to 5, but he did. Of all, I have 40 projects that we own long term. These are 10-year terms with discretion to hold another 10 years. Only 5 of the 40 have adjustable money on them. These guys were putting adjustable money on all their deals. So I let go of those deals, believing I would be able to buy late last year product cheaper. Unfortunately, the sellers haven't relented or capitulated at this point. But some of these guys have not 10,000 but 40,000 units. These are the biggest players in the world that are adjusting. And this is the best real estate class, apartments. This isn't the office guys and the retail guys. I know my viewpoint's a little very real estate focused because I'm not in equities, but it just seems like nobody's considering the catastrophe that could take place if a Starwood couldn't service half their portfolio.
Right. And I think this is going to be a development that might come up here. Dennis, do you want to chime in?
Actually, yeah, if I could just ask a question, my apologies if I missed at the start of your chat. I'm wondering if any news or heard any news about whether any regional banks or any banks at all have yet used the Fed window, if that's set up, how long that process takes, and the more that do it, the less stigma there would be. And I just wonder where we are on that. Does anyone know?
I do know that banks that we announced yesterday, banks have access to Fed window. That was part of one of the announcements, but no news on how long it took or anything like that.
I'm just wondering if anyone's used it yet, because the first thing people said is that, yesterday some people were saying we should punish any bank that doesn't. I believe you do have to sell equity or something and raise capital if you use it, which could be a real problem in trying to get people to actually access it. But I think the regionals ought to do it. And there's a third regional bank now coming up under big loss today, right? I forget what that
was. That process is anonymous, so we wouldn't know.
Gotcha. Okay. Thanks.
So I got a question here from the audience, and I want to remind everybody, go down to the bottom right-hand corner, leave your questions for our expert panel here. We got a pretty diverse group of individuals here that know a lot about lots of different sides of the market. One of the questions was, what was Silicon Valley Bank doing that JP Morgan Chase isn't? Why is JP Morgan Chase seen as such a much more reliable bank and a much more stable bank? What are the major differences?
Can I comment on that?
Yes, sure. Please do.
In a nutshell, they were providing below market rate loans to companies that effectively were burning money and or didn't make money, with a quid pro quo that those companies had to provide that money deposits. and then they would take those deposits and go do the same thing with other VC based companies. And that allowed them to significantly grow their deposits. So that is effectively what they were doing. And because they were below the 250 that JP Morgan had to meet, and in addition to that, JP Morgan wouldn't have engaged, I think, in that process of providing below market loans to questionable companies.
Okay, so you're speaking about this threshold now. Are we referring to the banking regulations that were rolled back in 2017, I believe, the Dodd-Frank regulations that were sort of loosened?
Correct, but I think that what they were doing was a bit nefarious with respect to providing those below market rate loans to companies that would not have qualified had they gone to bigger banks, and then as a quid pro quo, demanding that those funds be, basically given to them in deposits so they could perpetuate that to other VC companies. I think that was shoddy behavior, using the best word I could. I don't think that respectable banks would have engaged in that behavior.
So was this something that could have, you're saying it was sort of shoddy behavior. Is this something that should have been caught by regulators? Could they have done something about it, earlier on, or? Absolutely. 100%.
If I could just add to that, and I agree with much of what Gordon is saying on the business model that SVB had. But the other thing is that there is this FDIC insurance limit on deposits of $250,000, which is really low when you think about corporate checking accounts. And so over 90% of SVB's deposits were uninsured, and so that does just put it at risk of a bank run if there were to be some concerns that develop, which they did. And the reason that concerns developed had to do with what was going on the asset side of the balance sheet, which was just this unhedged, long duration treasury and mortgage-backed security portfolio that they really invested in when they got this flood of deposits during the VC startup boom in 2020, 2021. That comes into their bank in the form of deposits, and then on the asset side in the form of reserves at the Fed, which at the time pays 0 in interest. So they took that money and invested in, let's say, 10-year treasury bonds and mortgage-backed securities that have, similarly long duration without any kind of interest rate hedge. And then as interest rates went up, just simple bond math, that as yield goes up, price goes down. And so they're holding these bonds on the asset side of their balance sheet that have gone down a lot in market value that they're not marking to market. And then as you get deposit flight because of lack of IPOs, lack of fundraising rounds with VCs, deposits, instead of growing, were just starting to decline. And so they have to sell that bond portfolio to meet those deposit withdrawal requests. And so as they're selling that portfolio, they're actually crystallizing those mark-to-market losses on the long duration bonds. And it was clear, if you actually look at it in hindsight, I didn't see this, of course, but some people did, that if you just did the math, the mark-to-market losses on the bond portfolio were greater than the shareholders' equity. And that means that the bank is insolvent in the case of a full bank run, which is what happened.
Yeah.
So let me ask,
they were engaging in this business model of offering these below market rate loans to startups with no earnings. And again, the quid pro quo being, you have to put the cash with them in deposits. That's effectively in my view, a Ponzi scheme, right? Because you're just creating money, giving it to people, and then getting that money back and giving that same money to others. And by the way, they were doing all of this at a 9% tier 1 capital ratio, which is 10-to-1 leverage. So what I agree with everything that Nick said. He's 100% accurate. But I think looking at the beginning of this, before they got into trouble with the U.S. Treasuries and the duration mismatches, the way that their business was structured was shoddy to start with.
All right, so we have a little bit of news here. It looks like Moody's has downgraded and actually withdrawn their rating for Signature Bank. So I want to ask Michael Cow, if you're still here, what does that mean for Signature Bank and its depositors? I mean, would that worry you?
I apologize. Sorry, rephrase the question. I was zoned out a little bit.
Well, sorry about that. So it just came out. Moody's just released a statement saying that they have lowered their rating and actually withdrawn the rating for Signature Bank. So, in your opinion, what does that mean for Signature Bank and as well as its depositors?
I have one question. Is that bad? I'm just kidding. I mean, I don't know. I have not been following Signature on an idiosyncratic basis, but my understanding is that they had a lot of crypto exposure, and they've been seized. But I do think that again, going back to the state of this conversation a couple hours ago, when Robert was talking, I do think that this BTFP facility was designed to be a surgical Band-Aid to ring fence, or you can even think of it as a controlled burn for these shitty banks that did not practice any risk management. So I'm not that concerned, to be honest, about depositor losses at this point. But as I tweeted earlier today, do not conflate depositor safety with the safety of bank stocks, because I think, ironically, what this allows the FDIC to do is to actually be bolder in tipping over the poorly managed banks and just take them and resolve them, and either force shotgun weddings like we saw in multiple past financial crises, or to essentially liquidate them, but still make depositors whole. So I do think, from a bigger picture standpoint, it's bad for risk assets, because what it means is that the Fed is not going to sacrifice its inflation mandate, especially when the trade-off between employment and price stability is not evident in the macro data yet. So I think there will come a time when that happens, and yeah, that. Unfortunately, that is what the Fed is trying to do, right? The Fed wants to see the unemployment rate tick back up to 4.6%. And I have news for people, because look, that doesn't mean that the Fed is going to be concerned with job losses of 20,000 or 200,000. It means that the Fed is okay with job losses of 2 million. If that's what it takes to get inflation down, which, again, as I said maybe 2 hours ago, is the most repressive of all taxes. So it's very important. Like, a lot of us here are in business, and we are asset owners. And this is where I'm talking against my own book, right? Because I'm long assets, like many of you are. I'm long real estate. I'm long, assets that will get hurt by this. But I'm trying to be objective and recognize that, look, what the Fed cares about right now is that inflation is the most repressive tax. It affects everybody. It doesn't affect just Silicon Valley venture capitalists. It doesn't affect just commercial real estate developers. It affects everybody. And Joe Blow on the street is having a very, very hard time making ends meet. And
so Michael, how does 2 million unemployed people help anybody? I appreciate what you're saying. I'm just curious as to how anyone can think having 2 million people without a job and on unemployment would somehow solve a problem for our country.
Well, it's not a perfect solution, right? But it's all trade-offs, right? So those 2 million will be having a hard time, but then there's another 328 million people that will then have more affordable goods and services, right?
Okay. So I got 2 million that are on the dole, that can't afford to buy anything, that are late on their rent, late on their car payments, so that 320 million people get to go do dumb shit on the weekends.
No, I think if you consider dumb shit paying rent and just getting by, I mean, you know, it's, I think.
But how do I pay rent if I don't have income?
Well, again, there's no perfect solution here, right? I'm just saying that this is a matter of trade-offs to the Fed, and I'm kind of calling it like it is. I don't want to lose value in my real estate portfolio. I don't want to lose value in my financial assets. But the state of the economy is such that, you know, by far, I think the more pernicious problem is inflation affecting everyone versus asset owners, right? And I'm just calling it like it is. I can't tell you that I like it, but I think that's what the Fed is going to be focused on.
Can I jump in real quick? Just to add on that. You know, what Michael was saying, basically that we should continue to, you know, go down this path. And we're coming out of a 12-month or more than 12-month bear market. You know, the 80% throughout history, 80% of bear markets have lasted 12 months or 30%. We nearly had both. For this to, you know, for us to just continue to hike rates aggressively like we are, businesses aren't going to last. Not just the banking sector. You know, any sector will start to go out of business because they're all tied together. So, and when you say inflation's important, the price of oil is $70 a barrel right now. So, just looking at some of what some of these analysts have said today, for instance, Evercore, Fed might pause because of Silicon Valley situation, unemployment rate up to 3.6%, and commodity prices new low. Goldman, they should do 0. UBS, 25 basis points, but we have to see inflation numbers tomorrow. And then, last point, I'll let you guys talk, but the Fed, Powell's mouthpiece, Nick Timmerose from Wall Street Journal came out at 4 p.m. and said that the Fed raises rates historically until something happens. And, you know, he's surprised that over the past year, nothing broke. And that expectations are the Fed to hold steady at 4.5 to 4.75%. Tomorrow, that's going to spread. This article is going to spread. More people are going to be in the assumption that Fed might be pausing. 25 at most, but pausing. And I don't know. I think there's going to be a different tone. So I'll let you hop back on. But, you know, inflation's a lagging indicator. So we've been doing so much. You got to wait and see. There's nothing wrong with taking a step back and seeing what happens. And we got to do more in a few months. So be it. But I don't know. What do you guys think?
No, I hear you loud and clear. It's just that the latest prints, whether you talk about jobs data or the core PCE, have been kind of going in the wrong direction. And so if you talk about what would happen if the Fed, forget about just pausing, but what if the Fed were to reverse course, as many are advocating?
Well, why did that go in the wrong direction, though? Why did that data come in strong? Did China reopen? Did we have, you know, usually these things don't go in straight lines. So to draw huge conclusions from the last report, because the one before that showed it was going down a lot. And yes, it's sticky, but you know,
very sticky. Yeah. No. I don't have a beef with that at all. And you know,
but it's usually sticky until it's not, and then it goes down pretty quick. So, you know, I think it's more of a threat at this point to do too much, and you start, you know, seeing what we've seen over the weekend. So, oil's at $70 a barrel. That was the biggest fear that people were saying, you know, a year ago. So what's the biggest fear now
Oil is something.
for inflation?
Oil is something I know a little bit about. Oil is something I know a little bit about, and I can tell you that. So I think part of I'm personally surprised that oil is as high as it is, just given that the Great China reopening has really been kind of a dud, and China. A lot of people were thinking that between the EU embargoes on both oil and products, that it would force Russia to curtail production. Nothing happened. I've been saying for like the last year and a half that basically none of these measures are going to work in terms of stopping the flow of Russian oil unless outright blockades, which would be casus belli. So that has not happened. And China's economy, if you take a look at my pinned tweet, I wrote a thread over the weekend talking about how this whole idea of China's so-called pristine sovereign balance sheet is a complete facade. I mean, they have a very, very complex interplay between SOEs, property developers, and the LGFVs. And China is actually the most indebted country on earth. And to me, this whole Silicon Valley Bank thing is kind of a sideshow, especially now that they ring-fenced it. I think the real ticking time bomb for the global economy is actually the U.S. credit China is hooked on, and they can't get away from it. They cannot, despite what all the anti-U.S. dollar people will tell you, they cannot get away from it. Anyways, now I lost my train of thought. But
Hold
inflation, yeah.
So you said, with oil, you said you're surprised how high it is. That's $70 a barrel. All right, below 100 doesn't add to inflation. There's facts behind that. I'm not just picking that number out of the air. So if that's 70, what are we concerned about? So what's the biggest cause of inflation?
Yeah. So let me get back on track on oil. So what I was saying is that I think that oil based on macroeconomic headwinds should probably be lower in the short term. But I don't know if you missed it earlier, but I said that oil has been starved of long-term capex. There are a lot of people that are misinformed out there, including people in the highest echelons of power in our administration, that somehow think that we are going to get back to all-time high, another shale boom. It's not happening. It's not happening. The Permian Basin accounts for 75% of the 12.5 million barrels per day that we produce, okay? Permian Basin, according to the most knowledgeable oil and macro analyst I know, is about to reach peak supply next year. So at the same time, we have an administration that's basically gutted our SPR down to like 1981 levels, and has effectively transferred that SPR to China. Okay, so if there is a true geopolitical problem, you will see oil go to 250 or 300, regardless of what the GDP is, regardless of where we are in the economic cycle. So it's a big problem, and I agree that part. Oil is something that higher rates will not solve. That's why the paper that I spoke about earlier that we presented at West Point advocates a twin solution where you have to have smart industrial policy, at least industrial policy or domestic policy that isn't actually shooting ourselves in our own foot, which we are doing there, So absent coherent industrial policy, the only thing that you can do is to try to lower aggregate demand, to try to keep the herds from just really getting out of control. I apologize, everybody. Thank you so much for having me. I need to run to dinner. So really, thank you for having me.
Gotcha, Michael. Well, let me know. We'll still be here probably for the next 3 days, cool. Probably. But
right. Anyways, thanks a lot, everybody. All right, take care.
Thanks, Michael. Joe, jump in.
Yeah, I actually had a question for Gordon. you had mentioned about the M2 money supply and going deflationary. I'm sure there's almost 10,000 listeners. Some of this audience has probably listened to Ray Dalio. Did he just jump off?
Yeah, it doesn't seem like there's any sort of Gordon here.
He ran. He was just on.
You waited so long to ask that question, too.
Yeah, but maybe someone else knows that's here. Any of you guys watched Ray Dalio and his theory about the fall of empires, and it goes deflationary before it goes hyperinflationary? Any worries about this being the start of it? Because I did look at the M2 supply that does typically signal deflationary. We haven't been that way since the 40s, right before Bretton Woods system, the first one. That's actually what caused the Bretton Woods system to happen, to get that deflationary things under control, which then broke in the 70s, and we took away the gold standard. Like, this had serious consequences in the past. Are we going to get there? Is there a threat of getting there? What are your guys' thoughts?
Somebody up here has to have a thought or two, maybe.
I'm going to pick on Douglas if no one else answers.
Yeah. So we're working on getting more panelists here, guys. So bear with us. But
I'm here. Just ask the question, please.
Yeah, just about. Are you familiar with Ray Dalio? Yeah.
Principles.
Yeah, and so his theory about empires and how they fall. M2 money supply did drop greater than ever before. It is going negative. That does normally signal deflation. That hasn't really happened for a long period of time, except in the 40s, which led to the Bretton Woods system that didn't really work out too well. To get this deflation under control is why it happened. Are we headed there? Because it's weird. This is a very weird signal, and you have a major hedge fund manager has been screaming this at the top of his lungs for the past 4 years, or maybe even more. And I'm sure some of these listeners have watched that and listened to it.
I went to business school at night. That's a heavy lift as far as putting on my my economist hat's concerned. I don't want to be a dud on this question. I am not equipped to answer that, and I'm just going to be flat out blunt about that. I could not tell you if one person's screaming at the top of their lungs, deflation can't get under control. I'm sorry, I'm not your guy, Josh. I'm humbled you'd pick me to answer that question.
Yeah, sorry.
This is above my pay grade.
No, I mean, you're definitely super transparent all the time, and really appreciate it. Authentic when you don't know, you don't know. So I appreciate it. Anyone else on the panel?
I'm really good at bullshitting anyone, but this one.
Hi there.
This one is.
I can try to address that.
No way I can do it. Yeah, there you go.
Go for it. Hey, welcome to the panel.
Yeah, thanks for inviting me up. I appreciate it. Yeah, I mean, I think it's an interesting thought. I mean, the one thing about Dalio's analysis, which is really interesting because it spans so much time, right? He goes over the Dutch guilder, which was one of the earliest reserve currencies that he analyzed, and then he went on to the to the British pound and then the US dollar. The one interesting thing about all of that is that basically of all the things that topple, right? Long-term real estate prices, et cetera. Actually, the reserve currency status is one of the few things that lasts for a very long time. So I'd say that no matter all the things that happen, the reserve currency will sort of be like the last domino to fall, at least according to sort of century analysis. But yeah, I mean, it's a really interesting piece that I've looked at a lot, but of course, happy to talk more about it if you have specific questions on it.
I mean, commercial real estate's normally a sign, and if you look at inflation-adjusted housing prices, in 2018, we were still actually lower in price than 2006, and it only really took off in 2020 after we started printing money. And typically, that would have a tendency to snap back to where inflation is. So I'm starting to see some signs of what Ray Dalio has said and talked about.
Yeah, definitely. And
I will.
I think one of the things that he talks a lot about is the fact that basically the countries that have reserve currency status are very special in the way that, they handle things like this, right? Because, if you're talking about the Weimar Republic or, other countries that have obviously gone through this, like Japan and its deflationary period over a long time, they don't control the reserve currency in the world the way that, we in the United States, or I say we, I know this global audience, do. And so the advantage that we have relative to other countries, as I'm sure everyone here knows, is that, we can print. And at the end of the day, one of the interesting things about, these banks that have, duration issues, duration mismatch issues, and I'm sure SVB is not the only bank, as obviously we're seeing in the market. It's like kind of one of those things where you're, like we're in a tough spot, or at least the Fed's in a tough spot where it's kind of damned if you do, damned if you don't. But it's really interesting because it kind of is another kind of that could happen.
Gentlemen, this is Michael Taylor. Mike Taylor, I ran a healthcare fund for most of the past 20 years, and now I run a charitable fund, and I don't know, pontificate on COVID and other things, but picked up a couple of things along the way of running a book for 20 years, and mostly in the pod shops, Citadel, Millennium. U.S. is in luck because China has a shrinking population like Japan, and they're xenophobes. Alternatively, Europe has a basket case of a fiscal policy, and they are also can't stand each other, and worse, they don't speak the same language. In addition, all of Southern Europe, most of Europe, but certainly Southern Europe, has a population dynamic much like South Korea, Japan, and China, in that 30 years from now or so, pretty much, the population will be probably 30% smaller. So in my mind, the thought that there can be a replacement for the USD is real. So that was just
okay. So that's a little.
And Nick, do you mind before you continue with this topic? I know that Ram doesn't have much to.
Sure.
No, right. He dropped out. I'll invite him back up. He's got 15 minutes, and I want to ask him a few questions. But Vinny, do you mind just giving us a quick update on crypto? Crypto exploded today. I know there's lovers and haters of crypto, but can you give us a quick overview for anyone that wasn't here a few hours ago, because we did a section on that? Your thoughts on this spike that we saw today? Is that just an expectation of Fed reversing course? And how crypto spiked despite the issues that we've had with onboard and offboard, on-ramp and off-ramps?
Yeah, I mean, I actually took a long position on Saturday in the midst of the crisis, thinking that this will be resolved, and so it actually paid off well, because like my take was that the Fed had to step in and do something here, and it wasn't what they wanted to do; it's what they had to do, and so they had to do it to stem the potential bank runs. And I think you got two things coming out of this. One is the U.S. Banking system is a lot more fragile than we think, and that we are pretty much hitting a ceiling in terms of where the rates can go. So, it's. I mean, I would say 50 basis points is absolutely off the table. I don't care what the market's pricing in right now. I think 25 is the most likely outcome. I don't think 0 is the right number either. I think the Fed has to still keep on its guidance, and they'll do 25. But I think it stops at that point and basically goes flat. Now, this all depends on what happens with CPI tomorrow. But assuming even if CPI is flat, or I think we're good. The only thing that would change the view on interest rates would be if CPI spiked for some reason in tomorrow's numbers. So, how does it play into crypto? Well, I think people were positioning for. People looking at the strength of crypto over the weekend and realizing that the three biggest banks are basically being cut off. the fiat rails for crypto startups being cut off. These startups have to take money out of out of the banking system. They've got to put it somewhere. I expect a lot of them probably bought some crypto or increased their crypto holdings while they're trying to find bank accounts elsewhere if they had access to funds. But a lot of people were very scared, and there was a lot. Look at First Republic Bank down today. I think people who had previously probably not had too much crypto exposure probably thought, you know what, I don't like having my funds frozen the way it did on Friday with Silicon Valley Bank. This is go buy some crypto. So I think that's part of it. Obviously that's just conjecture. I don't know the capital flows, but I think the market reacted positively in crypto to what's going on because it's kind of what people have been saying for over a decade now in Bitcoin in particular, is that if you don't custody funds, you don't always have access to it. Now, I'm not saying crypto is the solution to everything, is part of the fabric of society, and but I think having access to diversity is important. So the same reason why you'd buy gold, you should buy Bitcoin. The same reason why you have other assets and not all, not have a single asset portfolio is the same reason you should diversify into crypto as well. This is someone who's been in Bitcoin since 2013 and crypto for a decade now. I'm obviously very bullish on crypto long term, but I think we have our challenges, and the banking sector is coming after crypto very hard. We've lost Signature, Silvergate, and effectively Silicon Valley Bank in 1 week. And the Signature shutdown was pretty suspect as well because they weren't really in any strain, at the point they got shut down. So I don't know, but I think I'm also not. I'm going to put it out there and say I don't think that we're going to see Bitcoin fly above 30,000 anytime soon. Not for at least a couple of months, maybe even the rest of this year. I think we're in a consolidation phase after the FTX debacle last year, and I think that's okay. And I think if we just trade sideways for a while and people can have choices of where they want to put their money, that's okay.
And can I add to that? I think that's great insight. But on the ground, I was kind of in the ring managing our crypto portfolio, and it was very special because we've been a client of SVB since 2015. And of course, come Friday, it was all bust and we tried to get the money out, but the wires didn't hit on time. So we have a crypto portfolio that we've had for a while. It's mostly, let's call it beta neutral or, relatively, it's like stable coins and things like that. But our on-ramps onto fiat, right? I mean, there's a big flight to safety. I mean, think of Friday night, trying to unwind our trades just so that we can be in as safe a position as possible, which to us was basically US dollars in our JP Morgan account. But what happened was our trading counterparties, who we've done quite a lot of business with over the years, I mean, like millions of dollars of business of trading activity over the years, they suddenly came to us. I had the traders line it up. They gave us the bid ask, and we're ready to execute some trades. But then the operations people came back and said, "Hey, we noticed you bank with SVB, so we need to re-KYC you, right?" This is Friday night. So at this point, it's their Singapore, traders and their Singapore ops people. And what was really interesting is we could not, we couldn't execute the trades, even though we're lined up to do that. And so we had no off ramp to fiat. We still don't because they're, they someone get back to us on Monday to re-KYC our JP Morgan accounts. It was kind of a sort of a dark time. As you all remember, USDC at that point I think was hitting like 89 cents. But what saved us was the fact that crypto, of course, is a global 24-hour traded asset that we basically get to control and trade at any time we want. So basically, we went to DEXs for the first time, right, decentralized exchanges, and we were able to make the trades that we wanted to do. And it was extremely cheap. I mean, ETH 2.0 is incredible, right? I mean, we're not active traders, right? We're like a VR art studio, right? But we happen to have crypto exposure. Significant crypto exposure. So we were able to do all the things we needed to do. And what's kind of incredible, I'm still kind of thinking about this, is in a moment where TradFi, failed us, really crypto really stepped up, right? And we didn't have to trust anybody. We didn't have to you didn't have to wait for somebody, in the US to wake up Monday morning to do KYC with us. We were able to do what we needed to do when the world looked dark. And so, I'm more, I bought Bitcoin back first in 2013. So I've been in crypto a long time, but, you always have the ability, in your head, you can call 911, and we've always theorized crypto will be there when, TradFi has issues. But Friday was the first time where, I actually dialed 911 and was able to use DEXs, a lot of DEXs, and they all worked great. I mean,
the positions were high. I mean, the network was pretty high, but I mean, some of these fees to trade lots of money was just a few bucks. So it was pretty incredible. And in terms of why crypto popped, what was interesting is we were trying to do what I think a lot of people were trying to do, which was we no longer had faith in USDC or even USDT. And so we tried to create a synthetic stablecoin by doing a short cross 1x inverse, basically to achieve a synthetic USD. So if you're like long Bitcoin, for example, you do a 1x inverse. But the problem was everyone was trying to do that Friday night. And so, you look across the dexes, basically the APY to do this, to hold that trade was like 20%. So you're paying 20% just to create a synthetic stablecoin. So, just super interesting. I mean, it was a really interesting. I'm still thinking about all the takeaways, but I just have to say it's been a very interesting few days.
So I have a quick question, sure, and I'll hand it back over to you, Nick. But just one question from my end goes to both of you guys, Vinny and Vinny. By the way, thanks a lot for spending 100 hours in the last 3 days with us. The narrative, what created Bitcoin was 2008. Okay, the global financial crisis. That brought the idea of what Bitcoin is today. Now, there's one narrative that's coming up in the last 48 hours, is that what we're going through today could be what decouples Bitcoin from risk assets and hopefully or potentially moves Bitcoin from a speculative asset to a store of value. Now, I know a lot of people in the audience, Michael is in the audience, he'll probably kill me for hearing this. Yes, I'm referring to Michael Green, but do you think that narrative holds ground? Because you did say that you don't expect, Vinny, you don't expect $30,000 Bitcoin for a while. Does that mean it'll take time for that narrative to kick in, or could we start seeing that decoupling from this year?
I think it's a dangerous narrative because crypto is already under threat by the governments of the world. And so thinking that the governments of the world will just sit back and watch Bitcoin soar to 100,000 without doing something about it is, I'd say a little naive at this point. And they already shut down the banks that running the crypto industry. They haven't shut down, which I'm quite interested in, is the on-ramps into things like Coinbase. So you can still go buy your Bitcoin, Ethereum, and they haven't gone after it from that perspective. But if there was a frenzy, I think they would. And so this is something which I think that I don't think that Bitcoin and crypto succeeds without the existing system breaking by itself. I think if the existing system is threatened by Bitcoin and it's still stable and functioning, the regulators will just basically ban it, stop it, whatever. And the reason that crypto has value and Bitcoin has value is that people can buy it. And if you can't buy it, trade it, if it gets banned, it loses value, and you'll have black market Bitcoin. You'll have and the value will probably be a fraction of what it is today versus the highly traded.
Vinny, what about the whole discussion about this all being an attack on Bitcoin? What we've seen with the banks in the last over the weekend. It doesn't sound very tinfoily. I don't want it to be conspiracy because there's just a few indicators to point towards that. I don't think that's the case, but I'd love your take.
No. I think it is the case. I think there is a crackdown on crypto. I wouldn't single out Bitcoin in particular. I think there's enough support, across the aisles that Bitcoin is.
Do they need to? But bro, do they need to crack down like we cracked down on ourselves?
No, they're cracking down. They're trying to crack down on what they believe is KYC, AML infringements by cryptocurrency companies, tax evasion, which, by the way, is not, this exists in crypto. We know this. It obviously exists in the US dollar as well, but there is a large amount of, there's a lack of visibility in crypto that's what they're trying to stomp out. And so, I'm just more balanced and practical about this stuff because I've been in it for so long, and I've heard the decoupling thesis, and I've had it myself.
It just comes up every few months. It just comes up
every couple of years. Yeah, it comes up, and when it happens, I'll believe it. But I'm firmly of the opinion now that for Bitcoin to replace banking needs to fail under its own weight, not because Bitcoin attacked it.
Yeah, I agree. Go ahead.
If I could ask a question for Vinny on top of that, I always thought that Bitcoin indeed will soar when it looks like the banking system might collapse. And yet, if you look at the Bitcoin chart, it finally soared this morning, right? But when we knew that the Fed was, that the FDIC was stepping in and assuring all of the deposits at SVB, so it kind of went up with the market stabilizing instead of going up early in the weekend when it looked like the banking system was in trouble. So is Bitcoin really a replacement for the banking system at all? Or does it just, is it tethered to it and it goes up and down with it?
Exactly. It's not a replacement for it. I think the banking system, Bitcoin is being designed as a store of value, and that's what it is. It's not a banking product. Maybe the original white paper was closer to a banking style product, but Bitcoin today isn't, and it's not a currency. You can't pay taxes in it. When you have, every time it goes in and out of dollars, you have to see a gain or a loss. It's not. It doesn't function for that. And your observations are absolutely correct. It should have soared over the weekend. It didn't. But that's because banking operates 5 days a week, Monday to Friday. And then when it's shut off, there's no fiat on-ramps and off-ramps into crypto. So the weekend traders take the weekend off. There's not much volume. It's largely bot-driven. Monday comes, banks are open. Funds are flying out of, I don't know how many banks today, including SVB, and going into places like Coinbase and other places you can buy Bitcoin. And people who have their funds trapped said, okay, you know what, let me buy some Bitcoin just in case this becomes a contagion at some point. But it's funds flow, right? The reason Bitcoin has value is because US dollars can fly into it, and China has banned Bitcoin and a whole bunch of other currencies. So and we saw that when that happened. By the way, we saw the demand drop. I mean, people were buying less crypto because China banned it, and Chinese traders had to leave China or not trade or not buy and invest in crypto. So it's a funds flow mechanism. And I tell people that Bitcoin is basically trickle-down economics for crypto, okay? Money flows into Bitcoin, then Ethereum, and then the rest of the ecosystem. It's top-down. And so you want to see an altcoin rally, it's fresh money goes into Bitcoin and ETH first, and then it goes to the other crypto underneath it. And so the decoupling mechanism for cryptos is unlikely to happen. Just for the same reasons, unlikely to happen in the banking world as well. So I'm pro Bitcoin, I'm pro crypto. I just think we have to be practical with what's possible in the current paradigm.
The one thing though, Dennis, is it did pump on Sunday, way before there was an announcement. It went up 10% on Sunday, almost another 10% today. So people did flee
it went
to
up
Bitcoin
after the markets in Asia opened. So after banks in Asia opened, that's when it went up.
So it's still tethered.
Correct.
Yeah.
I agree with Dennis, and I think it's the NASDAQ went up. Bitcoin, Ethereum up 10%, the same as Bill.com being up 10%, or some of those growth stocks. So the market is sniffing out the Fed might be coming to an end, and it's offensive based. So I think it all blows together.
KP and PDV, question for you guys. Is there, we talked about a few indicators earlier, a lot of concerns around Europe. Could we see a global contagion stemming from the US? Is that something that you guys have thought of? Is that something you guys are concerned of? Is there any indicators of that? There was an announcement by let me see where it's at. I was just reading that. Japan, I'm not sure if you saw it, Nick. Japan's finance minister, quote, "I am attempting to gather information on Silicon Valley Bank because I am not in a position to grasp the financial conditions of individual U.S. banks." Obviously, he's referring to U.S. banks, but just wondering whether we could see a contagion over the next few weeks and months.
I'll go in. Looking at the regional banks need to, I would not be buying them right now. They need to obviously settle down. So if you were overweight the banks at the start of last year, JP Morgan, some of these are great long-term opportunities, you're right now probably more neutral. And the regionals you want to stay away from. So do I think that's contagion where it spreads to other, outside the US? Not right now. It could, because you look at Europe, and some of these other countries, they're heavily made up of financial stocks. So it certainly could, but as of right now, no. And I also think some of these other countries like to, not to go off topic, but China and Russia, made a headline today that they were meeting together with Ukraine. I always, that's coincidental.
I missed that one. So is China and Russia are meeting Ukraine together?
They're set to speak with Ukraine, I believe it's next week. And, at a time when we got all this going on, that pops up. It's, it's almost like they wait for us to be at our weakest, right? So these things,
Holy shit! How did I miss that? That's insane. Because we've been covering the whole China tensions and Ukraine war very heavily.
It's China. It's what I read is it's mainly China going in there to talk to Ukraine, but
China,
so
but
closely tied to Russia. That's the same difference.
But Xi Jinping directly wanting to speak with Zelensky. That's the first time since the war.
Yeah.
So it could be just for optics, of course, and then many could make that argument very easily. But it's and timing could be coincidental because people have been expecting it. But it's still a very interesting. I see it's coming 9 hours ago.
That's when the market was down. That's when the S&P during the day was the most down. People fear that stuff. So,
yeah. By the way, if I could just, as a longtime market observer, having followed the crash of '87, the crash of 2000, the crash of 08, 09, the bungee jump for COVID, and all of that. I don't think global contagion has to be a big risk here at all. If we look back to 08, 09, how scary that was, the credit default swaps going on all over the place, the synthetic CDOs, I mean, and versus now, it's bonds and treasury and government-backed securities that just kind of got underwater because of the Fed furiously raising rates. It's just, to me, a far less fraught with risk situation. And I think that the economy worldwide, look at how resilient the U.S. consumer has been. Look at how unwilling the U.S. economy, the world's largest, has been to go into the recession the Fed is trying to force on it. And I feel like that's a reason that global contagion doesn't have to be a real risk here. The risk is, as someone else just said, it's just the regional banks, I think, for what it's worth.
Well, one of the things I had to ask this question to Robert, the former CEO of UBS that was up here. And he said international banks do own 10-year T-bills. There is a possibility. Last night with Vinny and Jason from All In Podcast, Jason had said, yeah, it's a possibility. That's why he's becoming a single issue voter. I'm hearing different sentiments now, and I'm wondering why, because they do own these treasuries. They are underwater, and estimates are they're 66% underwater with this, unless you guys know something I don't know, that they don't buy a lot of these treasuries, or they have different management of how they handle this thing.
If the Fed continues to raise rates at a crazy pace and they don't take into account what just happened over the weekend, then that's possible where, but that's not, for them to step in with the FDIC and intervene, and again, Powell's mouthpiece releases an article at 4 p.m., all these things, they're taking it serious. And if they raise 25 basis points, Mark would be okay with that. If they do nothing, I think the market will be even happier. Some people say, oh, Mark will take that as concern. No, they're not going to say. They're going to say, we're just going to pause and we're going to wait and reconvene. That they're not going to. They'll leave their options open. So both of those also depend on tomorrow's data, CPI. So if they raise 50, different story. Then you're talking bigger things. But they're not.
There's zero chance unless CPI spikes more than 0.1.
Imagine, Vinny.
There's no chance.
No chance.
Imagine that happens, man.
Yeah. As long as it comes in range, the expectations and median forecast, I mean, like even 0.1, even 0.2 up slightly, they could probably overlook it. I mean, it would have to be 0.3 plus for them to go 50.
Yeah, this will be the most highly anticipated CPI. You thought you had some CPI prints that you were dying to see. It's going to be
tomorrow,
so lit.
Historic one tomorrow.
It's going to be so lit. Are we having a CPI party tomorrow morning? Are we?
I'm waking up at 5 a.m. Pacific time to make sure I catch it.
Vinny, get the tequila, bud. We're
I'm a wine guy.
It's a CPI.
I'm gonna pull out the Screaming Eagle.
Get a Barolo.
What are your trades, guys? Tiger, what are you trading the CPI, tomorrow's CPI?
I try not trading into this sort of vol. Trading into vol like this it's like literally flipping a coin.
Yeah, I mean, there used to be.
I'm trading my liver with alcohol.
Yeah. There used to be a period.
You know what they say? The C in CPI stands for cocaine.
That's it.
All right, guys. Tiger.
Okay.
Jesus.
Yeah, I mean, there used to be a period where you were able to find alpha ahead of CPI day, but now the vol is pretty much priced in. There's no real money to be made there. Like if you look at the SPX chain ahead of CPI day, I mean, you're looking at like 50, 60 vols in most cases, right? Unless you want to buy just straight equity. But there used to be a lot of speculators ahead of CPI when the vol was cheap. Now it's not cheap anymore because people kind of figured it out that it was a higher volatility event. But personally, I can't wait for the day when no one gives a shit about the fucking CPI anymore, because I'm frankly fucking sick of it. I think at this point, I don't. Okay, so I want to address a few things first. So I don't know who said it, but I think it was KP. I find it hard to believe, and maybe it's at lower prices, but I find it hard to believe that Buffett and Co is not going to step in here at some point, at least for some of the regionals. I do think that most of them are in deep shit, but I think some of them present good value. I think First Republic is a great franchise. We bank with them as a fund, and they're great. I don't think they particularly did anything nefarious or mismanaged their balance sheet as badly as maybe others, or had some overexposure somewhere. I will say though, I think that, so they claim they only have like 5 to 6% exposure to technology related customers, whether it's a tech company or a VC fund. I think that might be slightly understated just because of the advent of crossover funds now. So I'm not sure if that's understated or not, but it could be understated. And yeah, so I do think that they present good value, but also I would caution a rate cut or pause as bullish. You don't typically want to buy the first rate cut or pause, because that means shit is not good and it's not going to get any better. So just be mindful of that. That's not a signal to go balls in on Coinbase stock right now. So just saying.
Hey, can I add to that?
Yeah, sure. No, go ahead.
So,
go ahead.
Okay, so I see you got NVIDIA as your background. Why not just buy the semiconductors? Stay away from the fire. Now, the banks, capital markets, some of those big cap like JP, Goldman, they're the best house in a tough neighborhood, as you say. But the regionals, I mean, yeah, maybe eventually someone steps in, but I'm talking about over the near term. They're rolling over. So why bottom fish when there's so many cheaper parts of the market, including semiconductors? They haven't really. Their charts are on both an absolute and relative basis are starting to go up. So yeah. I don't know. That's just how I think about it.
Well, I think there's a difference.
NVIDIA.
I think that there's a difference between loving a company and loving the stock. I actually sold the stock pretty recently because it's an egregious valuation at the moment. As amazing of a company as it is, as amazing of a leader and innovator as Jensen Huang is, and as much of a core AI enabler that NVIDIA has become, sort of like the picks and shovels. I think those are going to be the real winners in AI, if you want to talk about AI for a minute. But I wouldn't own much at the moment, to be frank. I'm not seeing any screaming opportunities. Yeah, there's trading opportunities. There's opportunities to be tactical, but I don't see many screaming buys at the moment. But NVIDIA, yeah, I think it's a fantastic company.
I know it's my my cover photo because it is my favorite company, and I've made a lot of money in that stock over the years. So, I'm happy to sort of have it as my banner, but I don't particularly like the stock. And there is a difference for everyone in here between liking a stock and liking a company. I love the company. I don't like the stock at the moment. So, yeah.
So, Tiger, correct me if I'm wrong, but it sounded like you mentioned the fact that we might see a scenario where Warren Buffett or somebody takes over these small regional banks, or might have an opportunity to do so. Is there any reason to believe that that would even be something that's necessary or even reasonable, given that it seems like the federal government is just going to back everything at this point?
Well, okay, I think we need to. So are you referring to a quote unquote bailout, or are you referring to the government, insuring the depositors? Because that's very different.
Well, it seemed like you were saying, and correct me if I'm wrong, but you were saying that it might be necessary for somebody like Warren
Yeah,
Buffett
because
to
I don't
take
think
over.
Well, I'm saying that Warren Buffett likes value where he sees value, and I think in the regional banking sector at the moment, I think that First Republic is good value. Full disclosure, I bought the stock today. I'm not trying to pump the stock. I'm just saying I think it's good value. I think they have a loyal, wealthy customer base on the individual side, ultra high net worth, and on the hedge fund, PE, and VC side. So I think that there is good value there. It's very sticky. And they have they have some backing from JP Morgan at the moment. That's the only bank that kind of had a stamp of approval from a bulge bracket, right? So I think that says something. So just keep that in mind.
Can I just add to that?
Yeah.
I mean, and I'm not a shareholder in First Republic. I do have an account there, but having lived in, I'm a Bay Area refugee, so I live in Southern California now and not the Bay anymore, but I spent about a decade there. And the only bank that can really compete in terms of service offerings with Silicon Valley Bank is First Republic. Now, I'm not saying everyone's going to rush out of Silicon Valley Bank to First Republic, but if Silicon Valley Bank doesn't, it gets wound up and no one buys the assets and the technology and the platform, First Republic Bank's probably the next best option for a lot of the tech startups and community if they feel that the money's safe there. So, and that can happen over a couple of weeks or months, but I'd say within 6 to 12 months, assuming nothing else changes, they would be the dominant Silicon Valley player.
I can tell you for a
Absolutely,
fact that I know a lot of folks in Silicon Valley who work in tech who have already moved their money there. And then some folks who moved it there on Friday and then freaked out on Monday, started moving it out, but they're still getting a lot of net inflows.
I have
It's a game of musical chairs between bank accounts. It's amazing.
One of my companies did that. We moved the company cash all from Silicon Valley Bank to First Republic on Thursday, and we were like, "Phew, we got out." And then the weekend, we're like, "Oh shit!" We were about to have an emergency call on Sunday morning. I'm like, "Guys, I actually said, can we please chat this evening after the markets open? Because I think we just waste our time on a call this morning. Let's see what the regulators come back with, because this cannot happen. You just cannot have this musical bank chairs."
I want to see the company that put its money into Silvergate and then got it just out into Signature and then just out into Silicon Valley and then just out.
I do have a company, and one of the companies I'm involved in. They moved from Silvergate literally on Tuesday to Silicon Valley Bank on Wednesday, and out of Silicon Valley Bank on Thursday. And I can't see where they put it afterwards, but it was one of the most stressful weeks, I can guarantee you now. It was eight figures of cash moving around.
Well, actually, Coinbase had a game of musical chairs as well recently. They got out of Silvergate, got into Signature, and I mean their deposits will be fine. I think they had 240 million in there, but they'll be all right. Yeah, I mean, I actually hedged myself a little bit. We recently opened an account at BNY Mellon. I keep most of the liquidity as a percentage of AUM at the prime broker who custodies at JP Morgan, so I'm not terribly worried. So yeah, we'll see.
Yeah, I mean, for people in listening, if you're in the US and you're trying to figure out where to store more than $250,000 in cash, I mean, obviously, I don't think you have to worry about that limit anymore. I think the Fed's basically they've written a blank check to underwrite, banks and the FDIC. I don't think we'll have a problem. But if you were worried, I do recommend up to about $2 to $3 million. You can use something like Wealthfront, and they sweep the cash into multiple banks, and each account's $250K insured. So Wealthfront's interesting. Mercury does that as well for businesses. So Mercury and Wealthfront, I think, are going to be the two biggest beneficiaries right now of, any paranoia that still remains behind the banking system. And I really think that this crisis has been averted. I don't think the Fed. I don't think actually we're going to have a banking crisis now. I don't think we're going to have. There may be some smaller banks that run into slight liquidity issues, etc. But I think this issue is behind us. The issue on the table right now is how much further can rates go up, and I think we're about to find out that they can't go up much more. And so the real question is, what does the slope look like coming down, and when does the market start pricing it in? And that's really going to determine whether the market rips or not. If we start seeing that, I think it's projected in December. If it starts moving up to like October, September, maybe even earlier, where we start seeing cuts coming in, that's when I think we go into a more bullish mindset. But I think just right now, just wait and see for the next couple of months.
But Vinny, let me ask you: is it?
Can I hop in?
Yeah, sure. KP, go.
So I don't know if you guys can hear me. I'm walking, but I heard both of you say when we get cuts, that's more bullish for the market. I would disagree, and I say it's more bullish when we pause, and we're probably not going to cut to the end of the year, like Vinny said.
No.
I say cut.
No.
You're not talking about rates?
No. What I'm talking about is when the market, the market's pricing in cuts in December. And what I'm saying is when that pulls forward 2 or 3 months, that's bullish. Right now, even like the pausing's expected. We expected to pause after the next 25, whatever it is, 50 or 25, and the next meeting. We're expecting a pause. The real question is, how long is that pause for? I think we've.
You're right. You're right. We're expecting a pause, but if they pause and if they do it, at the next meeting and they stop rolling off their bonds on their balance sheet, which they could do.
Oh, that's stopping. That's already stopping. I guarantee you. Like from my perspective, they can't. I mean, the problem is they've just underwritten 25 billion minimum right now, and I mean the total exposure for the industry is like 600 billion. Tightening any further is going to impair that number more. So the number's going to go up, and it's not a linear number. It actually can accelerate a lot faster.
2 years today down move in like 10 years going down. So the 2 year and the 10-year on table, that's going to be bullish and win that the back and get it. But,
We lost you, mate.
Yeah, I wasn't sure if that was me or it was him. So. Yeah.
Yo, real quick, I just want to say thank you. I don't want to get divorced, so I love you. I love you all. Thanks for having me up here for another day in a row. We'll be back tomorrow, I'm sure. I'm
sure.
I have to get some writing in. Maybe I'll write about this. What do you say?
There you go.
I'll use that as an exit cue as well for me. Thanks everyone. It's been good being here.
Oh, I got Vinny's back here. All right, bye guys. See you tomorrow.
See you guys.
Vinny, real quick question I want to ask you: have you used Stripe recently? Can you hear me?
Oh,
I mean, I use it almost every day when I'm buying stuff. But
have you used it in the last 48 hours since what happened? I'm asking because mine wasn't working, so I haven't heard anyone talk about it yet.
No, I haven't had any problems. I bought some stuff today on various Shopify sites, e-commerce sites. I think it's working. I haven't heard anything otherwise.
Okay, cool.
Yeah, so let me mention to you guys. It looks like the CEO of Citadel has just said that U.S. capitalism is breaking down before our eyes after the Federal Reserve rescued Silicon Valley Bank. So let me ask you, Joa, does that seem like a reasonable sort of conclusion to jump to?
You mean Ken
Are you asking
Griffin?
me? I
You
think-
mean Ken Griffin, the CEO, right? Okay.
Yes. Yep. So, Joe, Tiger?
Yeah, I mean that's crazy. That's absolutely crazy. What happened wasn't because of capitalism. I don't understand where his rationale comes from or what bias he possibly has.
I mean, between him and David Sachs, it really seems that if you have enough money in your bank account, it poisons your mind into hysteria.
Well, it's like you're a libertarian until you're not, right?
Right.
So it's like
It's like
I mean, look,
the new
these
there are no
guys- you have
atheists
to
in
remember
foxholes. There are no libertarians in financial crises.
you have to remember something. A lot of these guys, they have investments in VC